let's get started. We're going to start chapter 8 today. So just as an overview, we're going to spend a little bit of time discussing what exactly money is. We'll talk a little bit about the history, and specifically we'll talk about what are the characteristics and functions of money. We'll explain briefly some of the economic functions of banks. We'll look at specifically the Bank of Canada. And then next class, we'll get into the money creation process. So we'll briefly introduce here the concept of fractional reserve banking, and then we'll get into next class about money creation process. We'll also explain what determines the quantity of money and interest rates next class, and some insights onto the price level. Okay, so what exactly is money? So I guess somewhat of a definition would be that it's some type of object generally accepted as a means of payment. And a means of payment specifically is a method of settling a debt. And so it's the medium in which prices and values are expressed as well. So whatever that object is, we can measure the value of different items by, units of that object. Okay. As currency, it would circulate, anonymously from person to person and country to country, and would facilitate trade. And it is also the principal measure of wealth, because that's what your savings or investments would be measured in. But to get a better understanding of it, we really need to look at functions and characteristics. Okay. One of the things with the word currency is more about whatever the country declares as legal tender. We'll talk a little bit about that later. And of course, wealth is just, some store of money that you have. And wealth also can include financial investments as well. So what are the important functions of money? Okay, what does it do? Well, one of the most that's a good question, Spencer. So the interactive quizzes at the end of each class, we'll just hold those in the classroom, right? I'll put it up on the large screen, and then you can, do the quiz on your laptop or phone. Okay. So medium of exchange. So it's essentially an intermediary used in trade. And now it's really easy to understand, or easier to understand this, when we think about how we would trade in a barter system. And then we see how money is a significant improvement. So a barter system is any, mutually beneficial trade going on. No money is being used. And so you're just trading the actual goods or services. There's no intermediary. Okay. So, an example of bartering would be, suppose you have, I'm trying to think of suppose you have a smartphone, someone else wants it, and then you want something they have. Say they have a big screen TV. And so if you make that transaction, that's bartering, right? You exchanged a TV for a smartphone. Now, you may have realized there that there are some issues with that. So first of all, in order to have a trade actually happen, the two parties have to have something each other wants and needs, right? And then in the right quantity. So, you might not be able to find someone who wants to buy your smartphone. And so you might not be able to find someone that wants to buy your smartphone and at the same time have something you need, right? Some people may want your smartphone, but they don't have anything you need. So you won't be able to make a transaction. So a barter system is very inconvenient because you need this double coincidence of wants. You need to have both people having, what each other needs and in the right quantity. So the requirement for a double coincidence of wants makes a barter system very inefficient. And you can imagine that there would be much less economic activity if we didn't have money, because there'd be a lot of transactions that just wouldn't occur. And so I don't think you can overstate how important money is to the economic well-being of everybody. Because where does our well-being, economic well-being come from? Well, it's the production of goods and services, and then those are traded, right? So we wouldn't be producing near half as much as we could, because it would always be an issue of whether you could find someone that wants it and they also have something you need. So it would just be a very terrible system, and it would result in much less economic, and there's no wonder every single human civilization has come up with money, right? It's a a significant improvement over just bartering. So, this illustrates here the problem of the double coincidence of wants. So you could have one person has a banana, they want a pineapple. You have another person who has a pineapple, but they have, they cherries. And so they can't trade with each other because, this person wants cherries, but this person only has a banana. So they can't make the transaction, right? So that's the idea. So you can see then that money gets rid of this issue because you're using it as an intermediary. You can always find, you always can sell something for money and then use that money to buy something. So there's an intermediary there. And so this is one of, I would argue probably it's a most important function. Now, there's other functions of money that are important as well. So one is that it's a store of purchasing power. Okay, so with money, you can hold on to it and then use it in the future. So essentially, you're transferring purchasing power from the present to the future. Okay, and Nolan has a question here. In some countries, they have a legal tender system, but they have barter in the system as well. How does this work? Well, I'm not sure what country you're talking about, and I'm not sure why they would also have a barter system. There must be some peculiar situation there that I'm not aware of, but I mean, a little bit of bartering goes on everywhere, right? Some people might decide to put an ad on Kijiji. Maybe they're looking for something and they decide to put an ad up saying, I have this. Would anyone be willing to trade me this for that, right? You could do that. There might be a little bit of that going on, but for the most part, for 99.9% of transactions in the economy, we use money. Likely there is maybe, so it depends on the government. So there could be certain situations where the government hasn't been very good with their monetary policy, and so the citizens lose in the currency, and so then maybe they don't want to use the official currency to do any trading. So maybe then they would barter. But also there could be some isolated communities that decide still just, maybe it's just a small little area and they kind of know what they're going to produce and they just trade amongst themselves without money. But, for the most part, money's used everywhere. Okay. So the second function is store of purchasing power. Now, the third is that we can basically value everything. So it provides us a measure of value, or in other words, a unit of account. Now, the best way to digest this is just to think about how you would do, say, an income statement or simply just write down your own net worth in a barter system. Well, how do you do that? There's no money. So, if you have a house, a car, and some furniture, how do you write down its value? Well, you can only list value relative to other things. So maybe your car is worth 20 television set, or it could be worth 5 something of else. Like it's not clear, right? There's no common unit of account when you don't have money. With money, we simply just value it in whatever the object is. In our case here, the Canadian dollar. Okay, so this is again a very important function of money. It would be very difficult to do any sort of bookkeeping or accounting or do any financial analysis without having money as a unit of account. Okay, so those are the 3 functions of money. So that's why we like money. Those are functions, but there are also characteristics of money. And the most important characteristic is acceptability. So why would a piece of paper from the Bank of Canada that has, or the money that we use, banknotes, enable you to buy goods and services, but say, monopoly money would not be able to allow you to buy anything. No one would accept it, right? That's the key. So the main or the key, many objects could be used as money, but if it's not generally acceptable, if everyone doesn't, generally accept it as a medium of exchange, then it's money. So that's the key. So now, if we look at that applies to anything. If for whatever reason our class was stranded on an island and we had some small seashells or something like that, if we all agreed amongst ourselves that we can use these as money to facilitate trading with each other, then, it would be money. Now, so for the money that we use in Canada or in most countries as well, we there's also a little extra sort of government rule that makes it, that strengthens its value over and above it being generally acceptable. And that's called legal tender. So in Canada, the Canadian dollar is deemed legal tender. All that means is that if you owe someone money, then they legally have to accept the Canadian dollar to settle the debt. So if you owed the bank $2,000 and you went in with 2,000 Canadian dollars into the CIBC branch and said, here, this is to pay off my loan, they cannot legally refuse that to settle the debt. But you have to have a debt with them. So when you go into a convenience store, you don't have a debt with the convenience store owner, right? So they can refuse your money if they want to. And that's why a lot of stores, not so much a big deal anymore. We don't use money as much, but not that long ago, many convenience stores would have a sign saying they don't accept $50 bills or $100 bills because they were counterfeited a lot, right? And so they just didn't want to accept them. And they're legally able to do that because you don't have a debt with them. So the legal tender doesn't apply in that situation. So that's what legal tender is. Basically it's just gives added strength for it to be generally accepted. But that's it. So our money in Canada and most Western nations is what's called fiat currency. And it's not backed by anything. It's just a medium of exchange and it has legal tender. Okay. So money doesn't necessarily need to be backed by a gold or a commodity or any of that thing. As long as we generally accept the object as money, then it's money. But it has to be acceptable for it to be considered money. But there are some other characteristics that, an object should have if it's going to be used as money, and that's relative scarcity. So, think of sand on the beach. You can never use sand as a object for money, a grain of sand as an object for money because it's of abundant supply. It would never, ever have any value because there's so much of it, right? That's for the same reason we don't want people counterfeiting the currency because it just dilutes its value. It needs to have relative scarcity. Obviously, especially for the function of a store of value, it needs to be durable. You don't want to use, say, potato chips or, some types of perishable items as money because they will not last very long. And you also want it to be somewhat portable so that you can use it for transactions. So you don't want to use big, large stones or anything like that. So those are there's actually two more characteristics that are important. So again, it needs to be relatively scarce, durable, and portable. And also it should be somehow divisible. Basically, we're saying here you want to be able to make change, that sort of thing. We want something divisible to the extent that we can use it to purchase high and low price commodities. You wouldn't want to use something like an animal or living creature as money because it wouldn't be dividable, right? And another characteristic of money is that it should be fungible. Fungible just means that, just give me 1 second, I'm going to correct that font there. So fungible means that, suppose you had 4 quarters and $1 bill. You can interchange them and there's no difference, right? There's nothing dollar bill different than another dollar bill. So we're just saying that the individual units should be interchangeable each other, and they should be, that's the main idea here. You may have heard of non-fungible tokens. Well, with those, it's the opposite, right? One of those tokens isn't just interchangeable because a particular one represents someone's ownership in that digital work. Okay, so anyways, those are the 6 characteristics. If an object scores well on number 2 to 6, that's great. Still not going to be money unless everyone accepts it. Okay. Do you guys think, should we classify Bitcoin as money? If we think about the functions of money, so medium of exchange, well, it certainly has that potential. A store of value, yes, but it's terrible compared to regular money. Bitcoin just fell 50% in not that long of a time. That's a terror. And its volatility is substantial. There's swings up to 5% every day. So it's very, it's a very poor store of value. I certainly wouldn't want to, money in there to store value for next year because I have no idea what it's going to be worth. So it's not the best store of value. It can be used as a unit of account. That's fine. fine. Now, if we look at some of the characteristics of money, it has basically all of them, right? It's relative, well, the scarcity, so Bitcoin itself is relatively scarce, right? There's a certain limit on the number of coins, although I think it's possible to change the number of units. Or so right now, I think it's divided up to the eighth decimal place or something. So, I think I don't know if they can change that, but that's questionable. But in any case, there seems to be some built-in scarcity there. The problem is that anyone can make another cryptocurrency. There's lots of them. So in general, cryptocurrencies aren't scarce, right? So it's not that inconceivable for people just to all of a sudden want to dump their money in another cryptocurrency, and then Bitcoin could become useful. There's nothing really keeping people in there, so it's relatively scarce self. But I mean, so it does satisfy that, but overall, though, it's not. Cryptocurrencies in general aren't scarce, so there's no scarcity in terms of cryptocurrencies overall. If it was the only possible cryptocurrency you could make and there's no other cryptocurrencies possible, then, the scarcity argument would be a little stronger. But the big issue why at this stage I wouldn't really consider it money is that it's not widely acceptable. There's very few places that will accept it for payment. So that's key thing. But that is becoming more important. Now, one of the issues with these cryptocurrencies is that, in general, there's just a basic fundamental rule that for some object to have value, it must have utility, so useful. It has to be useful for something, and it also has to have scarcity. So we talked about the scarcity thing. It's Bitcoin itself is relatively scarce because there is a limit, but there's not a limit on the number of cryptocurrencies in general. So the scarcity argument isn't very strong. And then what's its utility? Well, I would imagine 99% of people are buying it just because they think that the value is going to change. For most of your you couldn't buy a house with it. It would just most transactions are worse with Bitcoin. So it's not really that great in terms of that. It doesn't really provide that much more. It's not really solving any problems of our regular currency. And then for underground stuff, nothing beats paying with cash. Cash is completely untraceable. So, I think there's some utility in being able to maybe do international transactions anonymously. There's, of course, underground market activities that can give it some utility. So there's some utility there. I'm just not sure if that justifies how much it's worth. So basically, yeah, that's my take on Bitcoin. It'll be interesting to see what happens. But if people think it has value because it's cool and different, then, it could, and people just keep putting money into it for whatever reason, despite the fundamentals, then I guess, it could be around for quite a while. I don't know. But it doesn't exactly, certainly the Canadian dollar or Australian dollar or any of these currencies are, much better fit the characteristics and functions of money than Bitcoin. So yeah, that's the idea there. So let's look at some of the comments here. Yeah, it's been used in the past for, there's some minor, relative to all of the transactions done in a day in, say, the United States and Canada, as a percentage, what do you think are done with Bitcoin? Probably less than half of, probably less than 0.1%, right? So it's definitely not really widely acceptable. It's increasing to a certain extent, but, think of the grocery trade in the United States as trillions of dollars. I don't know of any groceries, even if one grocery store accepted it, that it's so small that it's not even close to being widely accepted yet. And there really isn't much of a need to use, unless you want to do some sort of international transactions anonymously, or there's no point in there's no gain for you to use Bitcoin to go to the grocery store, because there's nothing wrong with the money we have. It works perfectly. like you're not fixing any problem, but I think there's a lot of utility in sort of these, international transactions. I think you could send money with Bitcoin a lot faster and easier internationally than you could with, say, CIBC Bank, right? Doing a wire transfer or something. So in that sense, there's some utility there because it provides people with a better international transactions. And from what I understand, it's fairly safe that way too. But just for everyday transactions, there's not much improvement in my opinion. So anyways, that's the characteristics and functions of money. Now, different objects in the past have been used as money. Of course, in history, people used the actual physical commodities like gold and silver, and they were made into coins, and those were the money, right? That's what was used for much of human history, different types of precious metals. So, does gold function? Does gold have the characteristics of money? Yeah, it's durable, it's divisible, it has all the good stuff. And, a lot of times in history, it was widely acceptable. It's relatively scarce. However, using gold as your currency is a bit risky because hold on one second. I just have to close my door. So the problem with gold is sometimes they would discover a new gold deposit and all of a sudden you have an increase in the money supply and that can cause a bit of havoc. It's generally relatively scarce. And so, yeah, it quite well as a form of, an object to use as a medium of exchange for many years. But, there's been some other interesting examples. So in this example here on this slide, people used playing cards for money, and this is a situation back a long time ago, and they were actually used as a form of emergency money. So this is what was it? So in 1685, you had New France. So there was a colony here in Canada from New France, and this colony suffered a shortage of gold and silver coins. And so the, intendant at the time, the person in charge, had to pay the soldiers and other employees playing cards. Essentially, what he did was he basically wrote how much. It was like an IOU on the back of a card. But anyone who, had this thing could use it and later redeem it for gold. So they were waiting on the shipment of gold from I guess, France, right? And so when that came, then you could exchange these cards for gold. But in the meantime, people could trade these cards amongst themselves because whoever has these cards can go and redeem them for gold. And so, this is a good example of an object that you wouldn't really think that it could be used as money, but it was. So these things probably, considering the time period, now it would be difficult to use a playing card as money because you could probably counterfeit it really easy. But back then, I'm sure it was much different. And, they're durable. At that time, in that colony, I'm sure they were relatively scarce. They didn't have an abundance of these playing cards. Why would they want to take up so much room on the ship when they came over? So probably but there was enough of them to serve the purpose there. So yeah, they had a lot of the characteristics, and then everyone here decided to widely accept them, at least until the gold shipment came in. So this is an interesting example. There's actually a currency museum in Ottawa. It's owned by the Bank of Canada. It's very interesting. They actually have some of these on display. So if you're ever interested, you can go to the link, or if you're in Ottawa, I thought it was very interesting. I've been there before, so you might want to check it out. Now, think about the first bankers. So surprisingly, the first bankers were essentially goldsmiths. This is somewhat of an oversimplification, but it's true. But the exact time period is probably medieval Europe. There's probably, it's a pretty accurate description, but I'm sure we're not covering all of the aspects here. Generally, goldsmiths were the first bankers. So if we're thinking of quite a long time ago in Europe, basically goldsmiths performed the basic functions of a bank, and including fractional reserve banking. So if you think about it, back then people would, use gold as money, right, in trade, but gold is very it's valuable. And especially in those days, it probably wasn't safe to have a lot of money in your house, or, a lot of gold near your house, or, it could be subject to theft. It was more violent back then. Although even nowadays you wouldn't want to keep $100,000 in your house, right? A little risky, right? So generally, you want some safekeeping for your money. And so people would, eventually goldsmiths figured out that they could offer this. So people would store their gold at the local goldsmith who had a safe. And then what's the goldsmith do? Well, the goldsmith is going to issue a receipt. So someone's going to deposit their gold and he'll write out something like this thing here. Okay. And it says here, received from Mr. Not sure what that name is, 25, not sure what that is. It relates to gold. And then it says, for which I promise, or I promise to account. This is, I don't know, the English is probably a little different in 1760, but essentially what this is a promissory note. So anyone who holds this piece of paper can bring it to the goldsmith and get that gold, right? So this is a promissory note, or also you could call it a receipt. So then this must be promise to account, promise to account, probably accounting in terms of, he's liable to give it to this person. So this goldsmith is this gold that was deposited is a liability to the goldsmith, and whoever holds this will get that amount. So as more goldsmiths began to issue these receipts, it became possible to take a receipt to any goldsmith and cash it in. So gradually the receipts began to circulate as paper money. Now, this makes sense. So think about it. If you're going to buy something, just think about it. If you want to buy something, you'd have to go to the goldsmith, get your gold out, take it to the person you want to buy something from, give it to them, and then you take whatever you bought. Then that person's probably just going to go to a goldsmith again and deposit the gold. So why not just trade the receipts, the promissory notes? So you don't need to go get the gold every time. So people realize that it's more convenient, more practical to just trade the receipts. So you could just give someone, instead of having to go get the gold out, go back, you can just give the receipt to the person you're buying from and they'll give you the object. And then now they have a claim at the goldsmith for that gold. And so that's the idea. So that's how you have paper money, but in this case, it's backed by gold, but the paper itself is used as a medium of exchange. And so that's the idea. Now we can go further here. So now leads into what's called fractional reserve banking. Now, the goldsmiths, so far in our story, they're not really making any money, right? So goldsmiths also quickly realized that, not everyone's going to come all at once to redeem their gold. So why not lend out gold coins from the safe and charge interest? They don't even need to, lend the gold itself out. Well, they could, but what they can do is just create more receipts than there is in terms of gold in the safe. And so this is how you can create money out of thin air. So we know that in this situation, the paper receipts from the goldsmiths are money, right? They can be used for buying stuff. So a goldsmith can just issue a receipt out of thin air, take a blank piece of paper, write a new receipt and give that to someone, but as a loan. And so that person, has to pay them back. So they'll have to pay him back they'd have to pay him back in the receipts or I guess in actual gold, right? But the key point here is that money can be created out of thin air by lending. And so that's what they did. And that's what a fractional reserve banking system is. So a fractional reserve banking system is where there's just basically more, promissory notes circulating compared to what they're based upon. Okay. And that sounds a bit strange, but it's not, there is risk to that because it is true if something goes wrong with that goldsmith, if there's some news about that, some negative news about the goldsmith that they stole all the gold or something like that, everyone's going to immediately go and try and get their gold back, right? And so that the system would collapse. But if, things are run prudently and properly, it's a really good system. And it makes sense to do this because it's very inefficient not to do it, right? First, it's giving some profit to the goldsmiths who provide this service. But second, you can, give out loans. And if the loans are made to start new businesses or create new economic activity, it's a positive thing. Okay, so that's the idea of fractional reserve banking. And in fact, that's the system we have here and in most countries, except we're not talking about gold. We're just talking about the fiat currency. So a particular commercial bank will essentially have made a lot more loans. Basically, any commercial bank in Canada, if everyone went to go take out their money in cash all at once, they wouldn't have enough to give it to them. But, in Canada, we've been doing this for hundreds of years, or 100 years, I guess, if you're thinking of, modern commercial banks. I don't know of any bank runs or too many issues. The United States has had a few problems with this, but for the most part, the system has worked well, although there is a bit of risk with it. Now, the government actually mitigates that risk because the government will promise, like in Canada, for example, any, I think, checking or savings account there's insurance on it from the government. So you can always get that money from the government if the bank doesn't give it to you. And I think it's covered up to $200,000 in it. So that really mitigates the issue with this type of system. I think this, as long as we have a prudent, properly run, responsible, accountable government, the fiat currency we have now is excellent. It's the best you can get. The problem is that if the currency we have, if you get a government that's not prudent or, I don't know, just not good at managing the money supply. So there's many examples of this you can see in, certain countries like Zimbabwe. There's, another example would have been after the war in Germany. So the big risk is that central bank could just print money and cause its value to inflate. Now, at least for the last 30 years, we've had low predictable inflation. But this COVID has caused some inflation concerns. They have been printing a bit of money, although they can just take that money out. So now they're essentially doing that. We all hear on the news now that they're going to start raising rates to get rid of the inflation. But, for example, in the United States, if Donald Trump could have had his way and been in charge of the Federal Reserve there, and he said numerous times the Fed's just getting in his way, he just wanted to overstimulate the economy. He would be printing money and just pretending that there's no inflation and telling how good the economy is doing. So, if you get someone that's not, responsible in charge of the monetary system, then having a fiat currency is an issue. So then gold in that sense might be a better system for that sort of thing, or perhaps something like a cryptocurrency. But if you have a well-run government, the people in the United States, Canada, Germany, all of the Europe, most Western countries, the people at the central bank are serious, well-educated people, right? They're not, some, I think you've even had Nobel Prizes, it's not a joke. They do have a serious, concern about running things properly. So in that case, there's not too much of an issue. There's no issue really with this fiat currency that we're using. We haven't, if you look at history, we haven't really had inflation over 10, probably the highest inflation we've ever seen was probably in the 70s and 80s. Maybe it was 15%. Other than that, for 100 years or more, I don't even know before that, but we haven't had any big issues. And we've been using a fiat currency since the 30s. So, it depends on the government. So that's sort of my answer to that question. The gold standard, because you tie the hands of the government from printing money, then that might be good if it's a terrible government. But that will cause a lot of problems because there's many times you want to increase the money supply, especially in a recession. You want to kind of smooth out the business cycle. Okay, so this is just for you to review. It's just another slide with some more information on the stuff we just talked about. And so that's the first sort of forms of banks. Now, interestingly, in Canada, and this was true in the U.S., any private bank could issue its own banknotes. In Canada, the first bank was established in 1817, and that's the Montreal Bank. So that was in Montreal. That's a picture of it there. And I guess this would be around this is 1870. It was actually established in 1817. So this is actually well after it was established. This is actually a picture of it in recent years, still there. So that was the first bank we had was in 1817. By 1891, there were 39 chartered banks with more than 700 branches across the country. And so banking practices and financial institutions changed and evolved as the economy developed in the 19th century. And at this time, banks issued their own banknotes, which were used as money. So here, this is actually, I meant to put this on another slide. This is a banknote from the government of Canada back then. So at this time, there was no central bank yet. So at this time, you had the government issuing currency. Back then, it was called the Province of Canada. They issued currency, and then so did private banks. So in fact, this is an example of a Montreal bank. So this is 1817. So this is a $20 banknote issued by the Montreal Bank. Now it's the Bank of Montreal in its first year of operation in 1817. The last two digits were written by hand on a template intended to last for more than a year. You have the signatures of the bank president. And you can actually see some of these at the Bank of Montreal Museum in Montreal. So now this is, similar idea to like the goldsmith. Whoever holds this thing has claim, it's payable to the bearer on demand. And so banknotes were originally issued by commercial banks. And so they were legally required to redeem the notes for legal tender. Back then, it was usually gold and silver. So there was a backing with gold at this. And, you would get this if you presented it to the chief cashier at the originating bank. But around 1958, this is where you had the government also issuing its currency. I think this is 18. It should be 1858. Yeah, this should be 1858. For some reason my escape key isn't working. So this should be 1858. So you had, again, as I said, you had the government currency alongside commercial bank currency. And commercial banknotes have been replaced by national banknotes issued by central banks or monetary. So this was about 1935. I will talk about that in a sec. So basically roughly around before 1935, you could, literally go into a cafe, buy a drink with a Molson's banknote and get change in a Bank of Montreal bill. So there was actually a Molson's bank back in these days. So, you had different types of currency. Now, this seems cool, but it's not a great system, right? What happens if the owner of the Molson's bank makes a risky investment and, the company might go bankrupt? Then everyone who holds these bills are going to be in trouble. They're going to be trying to pawn them off on other people. They're going to not have any value left. And, it could cause a lot of havoc. And so eventually in 1935, the Bank of Canada was established and it became the sole issuer of. And so then, and it's too, like, how do you have any monetary policy when you have all these different forms of currency going around? And so when the government tries to stimulate the economy in a recession, they're not able to do it because they don't have control over the money supply. And certainly private banks aren't going to be interested in helping out the overall population or, helping to alleviate a recession and stimulate demand again. So the Bank of Canada was established because, as I was mentioning, it becomes an issue if some of these banks go bankrupt, right? Because people holding that currency lose everything. So there was a number of private bank failures around this time. And inevitably this lent to pressure for the government to, take the lead here. And so they decided to open up what's called the Bank of Canada. And basically they became the sole issuer of currency. So that happened about 1944. So the Bank of Canada became the sole issuer of legal tender banknotes in and under Canada in 1944. So it opened in 1935. At first, it was actually a privately owned institution, but I'm sure there was a lot of government involvement in it, but the shares were sold to the public. So it was a public corporation, but, not owned by the government. I'm sure the government probably owns some of the shares, but in any case, that didn't last long and they amended the Bank of Canada Act to nationalize it. So the Bank of Canada is owned by the government and that's still true today. So the Bank of Canada is publicly owned and remains so today. And so this is an example of some of the first notes that they issued. So this is one of the first $1 notes in Canada. So now again, the money we use now isn't backed by anything. So in January 29th, Canada ceased redeeming Dominion notes in gold, and it also got off the gold standard. And so essentially at that point, we're just using, the money isn't backed by anything. It's just a piece of paper, but it's generally accepted, and it's also deemed legal tender. So that's what we started to use fiat money. It's been a long time. So it's almost 100 years. And, I haven't heard of any major issues in Canada, because a lot of people too, when they talk about Bitcoin, will bring this up, because on the face of it, fiat money, it sounds terrible, but it's not like it's a new thing. We've been using this for almost 100 years. We haven't had any major issues with inflation. So it is because we've been lucky, and our government has been, for the most part, responsible. They haven't let inflation get out of control. They've, for the most part, fairly good at managing the money supply, et cetera. We haven't had any issues like in Argentina or Venezuela or Zimbabwe or many of these other countries. Okay, so so fiat money is just not backed by anything. It basically has value because the government says it should, and we all generally accept it. So you could have the government saying you should use this money, but we could, as a group of, people, say, no, we don't. And some countries have that issue where they don't trust the government, and, whatever the government tries to use as the fiat money isn't really generally accepted. But anyways, in Canada and most Western countries, it is. The word fiat is just Latin for it shall be or let it be done. So it's just like a decree from the government. And then it also has the legal tender that's backing it as well. So that's, the main history. So that's where we are now. We use fiat money. So we already mentioned this. So most governments, and so the term currency usually means, so if it's the country's currency, well, then that means it's legal tender. Okay. So we already talked about this. I mean, commodity money has an intrinsic value. So there's different types of money. There's fiat money. There is commodity money. So it has an intrinsic value. It is derived from a material. So it's actually made out of gold. So this is a gold coin. Representative money would be what we had, I guess, after that. Generally, it's backed by a physical commodity and issued by the government. Like, like the old banknotes that were backed by gold would be representative money. But it can also, it could be silver, any of that type of thing, some type of object, right? And then there's cryptocurrency. So this is a digital currency free of a central authority, backed by blockchain technology. So cryptocurrency is, in terms of it being fiat currency, it's similar, right? With fiat currency, it's not backed by anything. Nothing's backing cryptocurrency. It's not even a piece of paper, right? With cryptocurrency, though, I guess the biggest difference would be that you have this built-in scarcity, right, for that particular cryptocurrency. But cryptocurrency in general, you can make as many different types of cryptocurrencies as you want. And if you note on our notes, we have this note is legal tender. Okay, so now this topic is different in many different textbooks. And if you go onto the Bank of Canada's website, there'll be slight differences here. We're just sort of simplifying it and just getting the main point. It doesn't really matter that much. So you could categorize money a little differently, but the essential idea here is that the first measure of money, M1, is always just your most liquid forms. So it's going to be coins, notes, and the bookkeeping entries at your bank. So whatever's in your checking account. And then M2 is just a little bit less liquid, and it would include certain savings accounts or maybe term deposits or something like that are a little bit less liquid. So M1 is essentially what we think of as the money supply. And it's, again, as I said, it's the currency held outside banks. So that's what's coins and notes in our pockets by individuals and businesses, plus checkable deposits. So these are just basically bookkeeping, electronic bookkeeping entries owned by individuals and business. And so currency outside banks in May 2020 was about 96 billion checkable deposits personal. Okay. Yeah, if the textbook, I think that, yeah, the textbook says fixed term deposits. Yeah, yeah, we would include that as well. I think I'll get to that in a second. I'm not sure if they mention it on the slide here or not. But anyways, M1 we're still at. So we have checkable deposits, personal with 354 billion. And then these are non-personal, so businesses and that sort of thing. These are their checkable deposits, much larger, 664 billion. And that's it. So that's the M1 measure, the core money supply, right? Now, M2 it equals M1, and then we just additionally add things like non-checkable deposits owned by individuals and business, which could be, as Daniela says, fixed term deposits. So sometimes you have savings accounts at the bank that you need to give them a few days notice or something like that to get your money out. I'm not sure who uses those. I've never met anyone that uses them, but there seems to be quite a bit of them, 792 billion. That's personal. So I'm not sure if some of this is seniors. This could be, I wonder if this might be including things like GICs and stuff. I'm not sure. You'd have to really work at the bank to get a feel for the exact things. It doesn't really matter here. We're just getting the idea. The M1 is the most important. M2 is just another category where we add some little bit less liquid forms. And then these are non-checkable deposits, non-personal, so business. So the key is the core of the money supply is M1. And just remember that M2 includes other deposits, but that are like, they might be like term deposits. They're just a little, they're more like savings accounts with some term deposits. I have a savings account at CIBC, but I can use my Interact and take money out and buy something immediately with that. I would consider that more of a checkable type deposit, or another term that I think is better than checkable deposits is demand deposits, where you can just use it to buy something immediately, where these might have some waiting period. They're a little less liquid. That's the main distinction. And so our M1 and M2 really money. Well, all the items in M1 are a means of payment, so they are money. You can use that bank bookkeeping entry in your demand deposit to buy something that rates straight out directly. So the demand deposits or checkable deposits are money because you can immediately buy something with that bookkeeping entry, right? Or you could withdraw it in cash in an ATM immediately. Now, M2, they're not means of payments, but they're quickly and easily converted into a means of payment. So they're very liquid. So they can be very quickly converted into, cash or a demand deposit. We consider, we kind of count them as money. But usually when we're talking about the money supply, we're referring to M1, but we could say M2 is money as well. But here, we're just categorizing, we're just making up definitions here. It's not really that important. Now, checks in and of themselves, or debit cards or credit cards in and of themselves aren't money, right? These are just basically different forms of transfer instructions. When you use your credit card is just a mechanism, I guess, to do a transfer from the credit card company's bank to the merchant. And then you're going to have a debt with the credit card company for that. It's just facilitating that, and a check itself isn't really money. Of course, a check can bounce, so it couldn't really be money, right? A check is just a transfer instruction. So that's all it is. So these things in and of themselves aren't money, but what underlies them. So a depository institution is a firm that takes deposits from households and firms and makes loans to other households and businesses. So that's the essential function of a bank or a financial institution. Sometimes these are called like savings and loans companies. So, they take in deposits and then they lend out money, charge interest, and that's one way. They make a bit of money off the spread between what they give the depositors and what they charge people they're making loan. Of course, banks do a lot of other things as well. So there are different types of institutions in Canada. There's chartered banks, credit union, and Caisse Populaire, and trust and mortgage loan companies. These are called near banks, and then chartered banks are, the original banks that were given a charter to operate from the government. There's not much, the main function for our interest here, there's not much. There are differences between these, but all of them essentially take a deposit and make loans. There's not much of a difference here. There's some I think credit unions, there's something I think everyone owns a bit of it or something like that. I've never used one. For the purpose of this, just be aware that of the names. These are near banks, but, for the money creation process that we'll be looking at in the next lecture, it doesn't matter. They're all the same. So chartered banks are deposit takers allowed by charter to offer a wide range of financial services. Near banks are deposit takers that are not chartered and have more specialized services. So, like a mortgage loan company or one of these credit unions, they can't say offer insurance, where the CIBC could offer insurance. That's all we're saying here. But the deposit taking, the savings and loan aspect and all that is what we're concerned about, and that's it's the same amongst all of them. So again, charter. Well, this is a little more detail. Why not take a look? It's not very critical. But chartered banks are private banks, right? CIBC is private. It's a corporation owned by shareholders. It's a public corporation, but it's not owned by the government. And they're chartered under the Bank Act of 1991 to receive deposits and make loans. In 2017, there were 30 Canadian-owned banks. So these are the big ones: Royal, CIBC, BMO, etc. And there was actually 24 foreign-owned banks. And all of these 30, including the 24 plus the big, so it's at the big six Canadian-owned banks, have the vast majority of deposits, in M1 and M2. Credit unions are very small. It's a cooperative organization. It just receives deposits and makes loans. So that functions the same. I think there's some maybe where you become an owner if you're a client or something like that. So there might be it might be a little less costly or something like that. Anyways, they're not very popular. They don't make up a big portion for most of Canada anywhere. And a Caisse Populaire is the same thing as a credit union, similar type of institution in Quebec. Trust and mortgage loan companies. Again, they're depository institutions. They make loans and deposits, but they also do things like act as a trustee for pension funds or for estates. Historically, though, there were sharp legal distinctions between chartered banks and these near banks. But they've actually become increasingly similar. So there's been some relaxing at what these other, these near banks can do, what different functions. And anyways, we can just not even care too much about the distinction between them going forward, okay? We'll just call all of these things savings and loans or commercial banks. So we'll just call these things commercial banks or deposit-taking institutions. And we don't care any more about the distinction between them. And so the Bank of Canada is the central bank. So this isn't a private commercial bank. This is, the government's central bank. The government owns the Bank of Canada, and it regulates the nation's depository institutions and controls the quantity of money. So all of the commercial banks have accounts at the Bank of Canada. So the Bank of Canada is like the bank for the commercial bank. Right. So you have all of the households, we all bank with the commercial banks, and then the commercial banks all bank with the Bank of Canada. And so the commercial banks all have accounts at the Bank of Canada. So that's the main idea here. And so because of that, the Bank of Canada is considered the banker to the banks, and of course also the government. So the government will do their banking with the Bank of Canada. And they're also considered the lender of last resort and the sole issuer of banknotes. We'll just go into that a little bit here. So the Treasury, if you think of the Department of Finance, who does all of the budgeting for the fiscal the fiscal section of the economy. So they're, if you remember, I don't know, we didn't talk about that at all yet, but for example, the federal government has a budget every year. They announce it to Parliament, how much money they're going to spend, how much they're going to take in tax revenue. So all of that financial related stuff is all, dealt with at the Bank of Canada. The Bank of Canada is the government's bank. Lender of last resort. So the Bank of Canada is the lender of last resort. So this just means that it stands ready to make loans when the banking system as a whole is short of reserve. So if there was any issue where people were withdrawing a lot in cash or any other type of situation, the Bank of Canada will lend to the commercial banks what they need. And banks can lend and borrow reserves from other banks in the overnight loans market. We will talk about that later. Don't worry about that for now. And it's also the sole issuer of banknotes. And so the Bank of Canada has a monopoly on this activity in Canada. And that might, for the most case, monopolies aren't good. I don't like monopolies or oligopolies. We seem to have more of these in Canada than other countries. It's the reason why we pay so much for cell phones. It's the reason why we pay a lot for a lot of different things, even the grocery trade. If you really start looking into it, most of the grocery stores are owned by the same Weston family. There's not that. I don't really like monopolies or oligopolies. I think we should try and promote competition as much as possible. It helps improve the overall standard of living. It prices low. And you saw that in micro, the best outcome in theory, anyways, you can think if you remember, is a competitive market structure. But in this case, it's not such a bad idea to have one group controlling the money supply, because then they can do monetary policy and help smooth out the business cycle. And, they've been really good at doing that. They've also been, up to this COVID issue, they've done a very good job at keeping inflation low, stable, and predictable, which is really good for the long run. And it's just recently that this has become an issue, inflation. And a lot of that is seemingly from the supply side. It's not so much that they printed too much money and that sort of thing, because they can always just, as we'll learn, the Bank of Canada, they're not printing money directly, but they're buying, they're going on the market and buying bonds or other government assets. And so they pay for that with newly created money, right? But they can go on the market and sell what they bought. They can make the price whatever they want, sell it, and then they can pull that money back out quickly as well. Anyways, up till now, they've done a really good job. And so if you had a bunch of different entities printing their own currency and we're using 20 different types of currencies, there's going to be all kinds of issues with that. It's not going to be good overall. There's a reason why in 1930s, when it was like that, they decided it's better to go with a single Bank of Canada, a single central bank that issues its own currency. And it's not, most Western countries that I know of have all done the same thing. So usually when that happens, it's probably a better idea. It's not just random, right? So anyways, a monopoly is probably not so bad on this activity, as long as, like I was saying earlier, you have a properly run government. So we'll just finish up with just briefly talking about the balance sheet of the Bank of Canada, and then we'll get into the money creation process. So I'm sure some of you might be taking accounting. We're not going to spend too much time on this. I'm not an accountant, but it's very easy to understand a balance sheet. All a balance sheet is it's basically showing you assets, liabilities, and owner's equity at any point in time. So if you just think about any business has assets, right? Assets are cash, the value of its buildings, any of that stuff. And then it also has liabilities. And so obviously the difference between those two are what its equity or net worth is. So that's what a balance sheet is. There's two main assets on the Bank of Canada's balance sheet. I mean, there's, Bank of Canada owns a lot of some buildings, they have chairs, office equipment, they have all those assets. We don't care about that. We're just looking at the main portion of their balance sheet that pertains to the financial things that it owns. So it owns the main things we're considering here is Canadian government securities and loans to bank. And then, so whatever you make someone a loan, right, that's an asset to you because you have claim on their money, right? They're going to be paying you that money back. So that's an asset to you. Now, it also has liabilities. The liabilities are the Bank of Canada notes in circulation, and then also the commercial bank's deposits with them. Now, that leads us to this thing called the monetary base. So the monetary base is the liabilities of the Bank of Canada. So basically, it's the coins and notes and the reserves, or these, banks' deposits at the Bank of Canada. We also call those reserves. Okay, so again, the monetary base base is the notes plus the coins. I don't know why it's listed as 3 here, but 1 and 2 are almost should be the same in the same category. And then you have the commercial bank's deposits at the Bank of Canada. Now, the reason why we use the word base here is because, as we'll see, because of fractional reserve banking, the money supply can be much larger than this monetary base. Okay, and we'll learn that in the next class. This is just an example of the balance sheet for the Bank of Canada. So again, you have your Canadian securities here. Of course, they're going to hold other securities. We're just concerned with this. And then loans to depository institutions. So that would be any loans to the commercial banks. And so the monetary base is all of these assets. But, a lot of the times we're just focused on the Government of Canada securities, but they do own other assets, and that's part of the monetary base. And on the liability side, of course, they have the notes and then reserves of depository institutions. So the next class, we'll start talking about the money creation process. So the lecture for today